Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates, 10-year note yields, ever so slightly down a little bit. We're not seeing a whole lot of reaction from the bond market. They are holding the range, though. Range that we saw started between 280 and 290 for some time. Now it's downshifted over, say, the last month to 275 to 285. So while we talked about 3% yields coming into the picture sooner than later with the Fed raising rates, with the economic data surprisingly high, with growth, with inflation, with everything falling into place, 3% seemed like just right around the corner, and now it seems very far away, and we're actually starting to see a shift move lower. Not a drop lower, but a shift lower. So we're looking at 275 to 285 now is the range. Previously, we were looking closer to 280 to 290 with an extension maybe up to 295. So things are shifting quietly. That should be something that onlookers should be warned or worry about or be cautious of, because the bond market typically does not move when it makes a move. It's certainly for a longer period of time. So yields starting to see a modest shift lower. Now, volatility we've seen in Treasury space has had its moments of being elevated. Not like 2017, where if you blinked you missed it. But we have seen elevated volatility in 2018 for a lot of good reasons. It starts in the equity markets. It starts with money moving around. There's obviously Fed policy changing. There's a lot of economic, geopolitical risks out there, and volatility should be higher. However, today was not one of those days. Today we saw volatility settle relatively unchanged and at very meager levels. So we're not looking at something that, even where we look at it from 50,000 feet, volatility kind of gives us a sense that the market doesn't really even have much of a pulse right now. We're hanging inside the range. We're seeing volatility lower. What's coming up ahead that might jostle that a little bit? And unfortunately, we have a lot of Fed speakers. And when I hear people talking about, oh, the Fed speakers are on, we got a number of Fed speakers on the calendar, they're going to give us some clarity. It always reminds me of 2016, when the Fed was really trying for the first quarter and a half of 2016 to talk up rates, and talked about Fed rate hikes of 3 to 4 times in 2016, possibly in the you have a mid-year rate hike, a third quarter rate hike, a Christmas rate hike. And then we ultimately only got that December rate hike in 2016. This kind of gives me the same feel as that when I'm being told that the Fed's going to come out and talk rates up. It means that there's probably very little action behind it. And I think the bond market is suspect of that as well. And I think that right now, as the yield curve continues to flatten or crater, as some have said, then I think that is an indication that long-term yields are going to remain in demand, despite the fact that we're starting to get to that near inversion phase in the yield curve, something we haven't really had a fear of. That's certainly been talked about, but I think reality is that we thought that yields would probably start to see a little bit of a bounce higher, but if they don't, obviously that's where we're headed. So right now, the data ahead, not only with Fed speakers, but data, we've got a lot of earnings coming out in the equity markets, which will probably take focus. And those are the things that we'll be looking at, probably not enough to move the bond market around this week. However, as we move forward out, more Fed speakers, more Fed meetings, we're looking at more, big moves in the equity markets. Likewise, any geopolitical risk out there could be the it moment, but I'm looking at growth. And we don't get that number, the advanced first quarter GDP, until the end of the month. So that could be the it moment for the bond market. If we don't get that growth, which we saw in today's GDP Now report at 1.9%, that could be troubling for the Fed. It's always been a risk of low inflation, not higher growth. Now you could see mixed inflation with low growth, and that's not a prescription for higher rates. This is Todd Colvin coming to you from the floor of the CME Group.